Hit it.
It's May 1st, 2020, episode 78. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we're pleased to welcome to the show Rob Hanna from Quantifiable Edges. Rob's unique style of quant research has been a fixture on the professional trading circuit since 2008, and we learn how Rob went from a financial software salesman to a full-time professional trader. Then we get to Patrick's Talking Charts, where he walks us through all the bear markets throughout financial history.
This week in trading history, we look back to the Mississippi bubble. As well, I'd love to have announced anyway that we were going to do a new WTF video, but Kevin is currently shooting blanks, so we're just going to finish with the top 3 things to watch next week. So let's get to it.
I remember the first time I saw Rob Hanna's work with Quantifiable Edges. At the time, there were few people publishing quant research, and I was blown away by Rob's unique method of looking at the markets. Rob Hanna has been a full-time market professional since 2001. He first began publishing his market views and research in 2003. From 2003 to 2007, his column, Rob Hanna's Putting It All Together, could be found twice a week on tradingmarkets.com. In January of 2008, Rob began Quantifiable Edges. In 2012, he opened his second website, Overnight Edges. Both sites use historical analysis to assess current market actions and odds. Rob utilizes price action, volume, breadth, and sentiment, as well as seasonality, liquidity flows, and more to conduct his research. His work has been widely referenced and quoted over the years, and is often linked to blogs, tweets, stock tweet messages, magazine articles, and many more. Welcome to the show, Rob. Thanks for being with us.
Thank you. Thanks for having me on. I'm really looking forward to it. I've been watching your show for a while, or listening, excuse me.
It's great to have you. I've been a big fan of your website, The Quantifiable Edges, for some time. When I reached out to you, you actually remembered me, so I was quite taken aback. I was like, oh my goodness, that's somebody with a good memory, can remember back that far.
Yeah, it's been a while. We haven't been in contact in a long time, but
That's
I don't
right.
know. Sometimes I recognize emails like I recognize sticker symbols, right?
So why don't you tell us a little bit about yourself? How did you get to the point where you're making this Quantifiable Edges? Like, where did you go to university? How did it all start?
Okay, so I went to Boston College, and I majored in economics. And I got the economics idea from one of my financial heroes, Alex P. Keaton, of Family Ties. Watched that show when I was in high school, and he was into making a lot of money, so I took his major.
Okay.
BC offers economics in both their arts and science school and their business school. And I'd initially gone into arts and sciences, but I ended up moving over to their business school because that did not have a language requirement. So I ended up being econ business. When I was at BC, I guess my first experience with trading was I worked for a firm called Garvin Guy Butler in New York City on their trading floor, and it was the area I worked in was they traded Fed funds. So I was the marker boy. This was 1991 summer, and
Okay.
It was just a bunch of brokers. The pit was basically probably about 20 of them sitting at their desks, and then they had like an elevated platform about 2.5 feet high that I would stand on. And behind me was a giant marker board, and I would hold like 5 markers because different colors I had to write with different things. And I was adjusting the bids and offers. I remember the first day I got there, I was always pretty good at math. And I get there, and the guy, his name was Angelo. He's like, oh, how are you? Nice to meet you. He said, where do you go to college? I'm like, I go to BC. He's like, oh, yeah. He's like, you good at math? I'm like, yeah, pretty good. He's like, okay, great. Go sit in the corner for the next 4 hours and learn your fractions. I'm like, what are you talking about? I know my fractions. He's like, yeah, you think you know your fractions. Wait until you got 15 brokers screaming at you, and you got to figure out where to put like 6 6/12 and 9/16 and whatever it is, it's got to go between these letters. So, or between these numbers, you got to know exactly what your fractions are to the 64th.
Right. So I had no idea, Rob, that they actually traded Fed funds that way. Like I knew that they was like a brokered market, and then that's what, but I didn't realize there was an actual physical pit.
Yeah.
Like that's fascinating. And so, and was this
And
in the
euro dollars
day?
too.
Well, yeah. So I eventually I knew euro dollars. I didn't know about Fed funds. So was this in the day when we actually had Fed funds? They didn't announce changes. They came into the market and just moved it, and that's how you knew that the Fed had changed policy.
Well, it was like it was Fed fund trading between banks,
Right.
right? So they weren't going directly to the Fed. So, but I can't remember. No, I think they had interest rate
Announcements, because I know at one point the Fed used to not announce their changes. What they did was they entered into the market, and then it was at 11:45 or something like that, and then you
Yeah.
have to actually make a decision about whether they intended to move the market and what that meant. But that's fascinating. So you're there, you do that for the summer. Do you go back to school after that?
Yes. And then
So you go
I
back.
could have gone back to New York and worked there, but all my buddies were staying in Boston, and I didn't want to go back and live with mom and dad and commute to the city or anything like that. So I'm like, I want to stay in Boston. I'll find a job here. And
Right.
um, eventually, I found a job with a couple of my roommates actually working for Thompson Financial.
Actually, can I
And
interrupt for 1 second before? So you're a New Yorker, like from Jersey or whatever, but basically
yep.
a New Yorker. Isn't there a notorious rival between New York and Boston? Don't you guys hate each other?
Yeah, from the sports standpoint, yeah. So
Uh,
I grew up a Yankee fan, right?
yeah.
And I was never. I'm still am. You can't make that switch. Like it's just so vicious. But the other sports, I was able. Like I always. My grandfather played for the Celtics in the 1950s,
Okay.
so I was
So
always a
you
Celtics fan,
right. So that was easy.
right? And then I was a New York Giants fan, and in 1996 or 95 or so is when Parcells came from the Giants and brought like 7 players with him. So I was like, well, I was rooting for all these guys before. Why don't I just keep rooting for them? So I kind of made the switch to the Patriots at that point.
Okay. So it was actually easy for you to go and switch to live in Boston. So you're in Boston and you get a job at Thomson Reuters. Is that right?
Yeah, back then it was Thompson Financial. It was
Okay.
pre-Reuters, and now it's Refinitiv. But I was selling investment software. It was their investment software division, and that was it was to like banks and insurance companies and money management firms, like big money management firms, and they would just manage their whole business on it. So it was a great sales job for someone that is pretty lousy at sales, like me. I mean, like I don't have the. I'm not a great marketer. I've been. So I didn't have to do a lot of cold calling or anything like that. It was basically we'd get sent RFPs, and then it was kind of sale that we'd go in and check out their business and show them how our software would work in there. And it took about 6 months to make a sale. You'd make maybe 4 or 5 a year,
Right.
and that was your year. And if you got a big one out of it, then you had a good year.
Right.
So that got me. While I'm doing that, I was also starting to learn more about trading and started doing day trading as well as some more intermediate term stuff, basically like William O'Neill, Investors Business Daily type things. But the day trading I liked a lot at that point because it was something I could be like, all right, I'm going to sit down at my desk for the open in the first half hour and just kind of trade some things.
Right.
And I would do my setups the night before. So like when I first started day trading, Trading Markets was one of the first sites out there. And I'd already read like Jeff Cooper had hit and run trading books, and Larry Connors. I'd read some of his stuff. So I would take Jeff Cooper's setups and have like a hit list for the next day. And if they trigger near the open, I'd take it, and then I'd normally be getting out in 10, 15 minutes or whatever it was, and then go on with my day.
Right.
And
so you were just trying to like ride away for a little bit on the open.
Yeah, basically. And this was like late 90s, right? So this was some, anything.com, it was just flying all over the place. And so one of the strategies I developed myself was to trade IPOs. And I would trade them on their second day of trading, right? So some hot IPO would come out, like pets.com or something great like that. And it would trade, 3 times the ask of the opening price first day, and then the next day I'd be like, all right, if it goes above yesterday's high, I'm in. That was the strategy.
Right.
And then I'll just ride it till it starts coming back down. But I would enter these things, and it would just rocket like in minutes. So I took I started with, I don't remember, maybe a $10,000 or $15,000 trading account. And I'd trade it down to like $8,000, and I'd trade it up to like 27,000, and I trade it back down to like 15. And then, so that's how I was kind of figuring out what was going on. And I got a little better at risk management over time. So,
right.
But that was a good intro to both, how to trade.
It's a great time is a great time to be learning. Lots of zip in those stocks.
Tons of zip, yeah. And when it went away, that was a great lesson too, right? Like the strategy I just described to you, well, you haven't really been able to trade that in like 20 years. So you got to move on to something else. I mean, some people will say, oh, you learn one tactic and you can just ride that. And it's really not quite that easy if you trade for any more than a year or two.
Well, yeah, because the other thing is that if a tactic is that good, what happens is eventually people come to it. You have right? You have the greatest arb in the world, and eventually people are there doing it as well. So you have to move on and adapt, and that's I completely agree that skill of being able to adapt is all important. So how did you adapt?
So one of the things I found at that time was that I was trading 2 kind of separate strategies. I was trading short term, like day trade stuff, and I was trading intermediate term, like cup and handle breakouts and things like that. And I found that a lot of the best short term trades were in my the go momentum stocks. I was trying to trade for the intermediate term too. So I began focusing more on just those types of things. One thing led to another, and then I got into quantitative analysis in around 2004. I think that was my first real. It wasn't 2002, 2003. I had really good years, right? And then 2004, I was flat, totally flat, and the market went up, and I kept getting whipsawed. Energy stocks would all be breaking out, and so I'd try and jump in them, and then they'd come back, and utilities would pop, so I'd try and pile into them, and they'd come back, and then financials would pop, whatever it was, and I was just getting churned. Right. So that's when I started rethinking a lot of the things that up to that point I thought I'd learned, right? And I started doing my own studies using TradeStation.
Right. Okay.
So I went and some of the ideas were that guys like Larry Connors, Larry Williams, who had done some studies previously, but I started studying it more consistently for my own. Just all right, this is where the market's at today. This is what I'm seeing in these stocks. Let me write a little code that will describe that setup and see what happens after it. I'm long and this happened today. Should I still be long? I'm short and this happened today. Should I still be short? So in doing that, it got me to learn an awful lot about the market and relearn a lot. And I'm still learning a lot. I mean, I don't know if you stop learning, you stop making any money, I think.
Well, that's I have a line that I say that all I bring to the party is 25 years of mistakes.
Yeah, you've been trading for 30 years, Kev. It's like
well, then I should change it to 30 years of mistakes.
It's like for 5 years you have not been making mistakes. It's only the first 25.
That's not true. So it's 30. So I'll change it to 30 years of mistakes, because I just find that you find new ways to make mistakes is so often what I find. So you're there in 2004. You start writing TradeStation code, but at this point you're not selling quantifiable edges. What are you doing with the code? You're just using it to trade for yourself?
Trade for myself, and I had a little friends and family fund.
Okay.
Right? So, and that was a great lesson as far, when you're trading for yourself and you have a bad day, bad week, bad month, whatever. It's one thing, it's like, all right, well, I'll make the money back. I'll get it back. But when you have a bad month, quarter, 6 months, year, or whatever, and you're trading mom's money and best friend's money and stuff like, it's a big difference as far as the mindset.
Right. Yeah. No, you're absolutely correct. It's anytime you have anybody else's, or you have a risk manager, or you're trading for a bank, it's a lot different.
Yeah, because and I don't think a lot of traders get that I don't think you can get that until you start trading someone else's money, and then and then you're like, oh my God, this is like, how am I going to get this back for them? I'm down 8%, I'm down 10%. This is terrible. This could take me a year to make back, or whatever it is. So. Right. It brings a different mindset. It brings more thoughts about risk, more thoughts about mixing systems. You realize diversification isn't just for wimps.
Right. So at this point, you're trading for yourself and for friends and family. You don't have another job, like you're doing this full time. You're basically a full time independent trader.
Yeah.
Okay. Yeah. And eventually you kind of you devise a system, your famous catapult system, right?
Yeah. So that was actually, I devised that. That was one of the first ones I came up with in 2004.
Okay.
Right. And I haven't changed it since. And so I've been using it, I guess, for almost 16 years. It was fall of 2004, I think I started trading that. And that became part of Quantifiable Edges. I decided, I'll just publish all those in the Quantifiable Edges letter in 2008. I started Quantifiable Edges. I just started it as a blog to begin with, right? And then I think I wrote like 2 blog posts, and I was in this big email group at the time, run by John Bollinger. And,
okay.
It was called the Markets List, and I learned a lot from. There's a lot of professional traders in there, and so I learned a lot from them. One of them was Dr. Brett Steenberger.
Okay.
And
who's a very famous psychologist, right?
Yeah. He runs the Trader Feed site.
Right.
And he writes for Forbes a fair amount of time now. He's at Steambab on Twitter. Anyway, I wrote a couple of posts that 10 people read. And then I wrote another one, and I kind of just put it out there to the Markets List, and Steenberger was one of the people on the list, and he'd had this Trader Feed blog for a while. So he decided to this is great. I can't remember what it was. It might have been about the catapults. And he reposted it and said something nice. And now it was like I had 4,000 people click on the link or something.
Oh, that's a nice post.
So
that was convenient.
Yeah. So I'm like, oh my God, what are all these people doing? and so now I had to come up with other stuff. And I'm like, all right, I'll just keep putting my ideas here. And then a couple months later, I was talking to him, probably thanking him for giving me the link. And he's like, why don't you do a newsletter? I was like, well, I've been thinking about it. He's like, I think people would like it. So I started Quantifiable Edges as it was just a newsletter, and then there was the blog, but it was that's all it was. There wasn't really a website at that time.
Right.
The website came about maybe a year later because I would put little systems in the newsletter. Like in 2000, I'd be like, all right, here's a trade idea for you. This is a system I have, and they'd be simple little systems, but to say, all right, this would be the entry, this would be the exit, and this is one stock that's setting up well with it, and let's see, how this does. And so I had subscribers writing to me saying, you're putting these little systems in the letter. It'd be nice if you had a repository or some place where we could go, like, remember them. And I was like, yeah, good idea. Let me see if I can start a web page and put it up there. So I found like a WYSIWYG editor. I don't think there was even WordPress. Maybe there was WordPress. I didn't know about it. And I just kind of copied and pasted the Google site, the Google blog, and screwed around with the code trying to figure out, how would I write a web page. Got far enough that I was able to do it. And a few years later, it upgraded. It needs another upgrade now, but that's how Quantifiable Edges basically started. It was just, my publishing my research each night, and enough people wanted to pay attention to it that.
So, Rob, can I ask you, like a lot of our listeners are not familiar with your work, and they should be. So can you just let them all know, like, what kind of a time frame do you usually look at? Are you looking like mostly like daily charts for like swing trade time frames? What is the how would you define the experience in terms of somebody that's following your work? What markets are you particularly focusing on?
Yeah, so it's mostly daily and it's mostly swing trading, right? I do some more intermediate term stuff, and occasionally I'll write something about like last 15 minutes of the year is typically.
And that's
down.
Predominantly on the indices, or do you do currencies, and like what defines your scope of analysis?
I only do indices. So, and most of the time it's mostly just U.S. indices, right?
Right.
A lot of the studies are based on the S&P. I'll look at the other markets, and I'll look at the impact of, what if the Russell's way up and the S&P's down today, or things like that. But a lot of times I'll look at the S&P as kind of the standard, and I try and set my market bias by looking at whatever studies I have available to me, right? So I will, I'll have, maybe 3 different studies any particular day. And one of them might be based off of, price action in the spiders. Another one might be based off of something the VIX is doing, and another one might be based off intermarket or Fed action or something like that. I'll look at anything I can that I think might give an edge. So a lot of the studies are price action because they're simple but there's a lot of studies that look at things other than price action. So it could be volume, it could be breadth, it could be sentiment, Fed action, whatever.
I guess the other thing is, Rob, when people are thinking about you, you really are a quant. This isn't technical analysis in that, like, you're drawing, cup and handles and, looking for
squiggles, you call them.
You're not doing squiggles. You're using math to try to identify edges that are technical, and maybe you could call them technical, but they're definitely math based. Would you agree with that kind of description of your work?
Yeah. So I learned a good amount of technical analysis, and that's kind of where I got my initial ideas for studying things. I wanted to know, what you hear that, hey, you have this shooting star candle, or you have this breakout to a 10-day high, or and that's supposed to launch the stock up or down or whatever it is. So I was able to see these patterns, and then I just kind of translated them to, all right, well, that's the code for it, and what really happens over the next 1, 2, 3, 5, 10, 15, 20 days, whatever it is I'm looking at. And most of the time it's short term, like you said.
Right.
I'll look
right.
out
And that,
5 days.
and that's the part that I like best, is that it's not just like this. It's not voodoo in that that it's not just based upon your hunch of that this works. You're actually going into the past and saying this worked X number of times, and this is the expected payoff. It's almost like you're the the poor man Jim Simons.
Yep, very poor.
Well, I think almost everyone's the poor man Jim Simons. Even like Bill Ackman is just a rounding error for that guy. So you have some examples of things that you brought along. Why don't you show us and walk us through it and kind of talk us through what you brought?
Sure. So now these aren't like the type of studies that I'll normally publish in the letter. They are things that I'm thinking about and looking at. Some of them I will, but I didn't bring any short-term ones, I guess is what I'm saying, right? Because if you listen to this 3 days from now, who cares? Right.
Yeah, exactly. You're right. These are edges or ideas that you base some of your theory or your studies on.
Exactly. So I'll run tests or design systems to help me learn about the market, right? So this first one that we're looking at here looks at S&P performance on Mondays. And what's so astonishing to me about Mondays is all this is doing is it's saying, all right, we're going to go into the S&P $1,000 at the close every Friday.
Right.
We're going to exit at the close every Monday. All right. And this goes back to 1947.
Wow.
And you can see from 1947 to 1987, Mondays sucked. Like, you could.
Shocking.
Yeah.
It's actually shocking. Like, for those that are listening, the chart is it's straight down, and it's consistent
top
down.
left to bottom right, just straight line down.
It's unbelievable.
You could, I don't know why anybody's system at that time was anything other than, all right, let's buy Monday and flip to short Friday.
Yeah. Well, who knows? Maybe it was. And so then in 1987, it changes, though.
Well, so, yeah. Now, this is the whole point of this is things change, right? So we talked about adapting and all that, but this is a massive things change. So Monday sucked for 40 years until, look where it stops. If you can't see the chart, it is Black Monday. The worst Monday of all time was the end of this Mondays being bad.
Right. And then it rallies back up, and now it's just a sideways. It's basically
it's
down
sucking, actually.
sideways.
Yeah.
I guess you could argue that if the fact that it's going sideways is even considering that the stock market rises over time, a sideways is really down.
Yeah. So after that Black Monday, what I see there, and this is just my interpretation, is that for the next 25 years, it was kind of doing whatever the market was doing. Like, it wasn't a special day anymore.
Right.
And maybe people were just so afraid of Mondays that they would start getting out on Fridays instead of wait until Monday, or I don't know what changed, but Black Monday somehow changed it. And interestingly, it changed again, like we see on the chart in like 2012, and you guys were noting, we've had a strong bull, up until a month and a half ago, a strong bull for 11 years or whatever, and Mondays have not participated. They've been slightly down.
Right.
So, yeah, they're sucking again.
At minimum,
and that in itself
Yeah, we could conclude that at minimum, the gains are not made on Mondays. And so, like,
Right.
now, were you able to determine which days actually are the best performing?
Uh,
The reciprocal of this, sort of?
yeah, I can't recall off the top of my head. I haven't looked at that in a
All right,
long
no,
time.
I was just
But
curious.
it probably wasn't. Was it more spread out? And that's why you don't have.
Yeah, it wasn't like there was no dominant day. Like
Yeah.
there's no straight up for 40 years on Thursdays like there was, straight down for Mondays.
Right.
They were just kind of went along. They mostly go along with the market.
That's just fascinating. Now we basically, this last little bit, the Mondays are once again down, but that's because the stock market's going down.
Right.
Like in the last.
Oh, come on! This is a weekly
here.
chart, dude. Like we were talking about with the last month. That's barely a.
Yeah, I guess so. It's down a little bit.
Yeah.
Okay, well that's interesting. Let's go on to the next chart. What do you have for us?
So this next one looks at. So this is just a table I did, and I thought this would be interesting to talk about in light of where we are now with this massive market decline and then huge rebound we've had so far. This looks at all bear markets back to 1928 as far as my data goes, right? So, and this is for the S&P 500. Prior to 1957, it looks at what was the S&P 90 at the time. And what I'm doing here is I'm looking at, all right, how far did we drop? And then how long did it take to go from the high to the bottom? I defined bear market as any 20% decline from a 1-year high, right? And then I said, we're out of the bear and started a new bull whenever you make a new 1-year high. All right, that kind of resets it so you can then have another bear. That way we can have more than one bear in the 30s. And since there were multiple drops of like 50% or more, then you probably want to be able to identify them as bears.
Right.
What stood out to me here is that the top to bottom decline from February 19th, to March 23rd, we dropped 34% in 23 trading days. Every other bear market has been at least 70. That was 1987. There was one that was 70. And then 1961, there was one that was 134, which is a 6-month decline. So 70 trading days, you're looking at over 3 months. We had an entire bear market in a month, if it's over.
It's not.
Right. I'm kind of with you. I don't believe it's over, right? But this would be one reason to say, first of all, can a bear market really happen in a month? If we go to new highs, would you guys still consider that it's a bear market? Like, isn't a bear market a long-term decline?
I would think if all the markets, if the Nasdaq made an all-time high, but the Dow and S&P didn't, I wouldn't count that. Like, I mean,
oh my God,
Jesus,
oh my God, you would just figure out a way to be bearish, eh, Patrick? Unless all of them were up, I wouldn't count it as a bear market.
Look. All right. Well, you know what? The Dow back in 2000, like 2001, 2002, made it to not all-time high, but very close to a high. But the Nasdaq never did, right? Because the Nasdaq bubble burst, and so like there was a massive divergence between those markets. And so like I just think that you can't have just one element running to a fresh high. Anyway, forget it. Let's let him talk. All right?
Yeah.
All right.
Yeah, no, I agree. But so the question now is like, I think we closed April 17. The S&P was 17% away from a new high. It was up over 12% in April. So we're moving at a pretty good clip here. Could we get another 17%? And if we do, I don't think I'd we had a crash, but was it a long-term bear? Well, I don't think so. Here's the other thing that I'm wondering about. What happens if we do hit a new high, like with society here? Unemployment is massive. Can you?
Yeah.
Things aren't good.
I'm with you, buddy. Like this is where you're gonna get
is huge. Yeah,
you're triggering Kevin because Kevin's on this. Well, the Fed is going to engineer everything. Like, give me a break. It's a bear market. It's a recession. It's
okay.
All right,
let's go on. Let's stick to charts for now because Patrick's going to go or stick to technicals and quant. So what's the next one? Let's go to the next chart here.
All right. So this is the one I'm having the most fun with right now. This is a system like the Monday system. I don't recommend trading it. Go for it if you want, but don't blame me. This was designed just to learn about the market. Like, all right, buy every Friday, sell every Monday. We're going to go long anytime the S&P closes up. We're going to go short anytime it closes down. And what this does is it helps you measure, all right, are we getting follow through on a day-to-day basis, or is the market more likely to chop back and forth? So this chart goes back to 1928. And what we see is in the 30s, there was an awful lot of chop, right? So the market was getting reversed harder than it was following through on a day-to-day basis. That stopped in around 1940 or just after. And for the next 60 years, there was follow through on a day-to-day basis, right? So if the market was up today, it was probably going to be up tomorrow. If the market was down today, it's probably going to be down tomorrow. And the trends just kind of pushed. And it didn't matter whether it was a bull or bear market. You can see, like, it went through a few bear market phases, and the line just kept going up, right?
Yeah, that's fascinating because there's the 70s. There was a big bear market there. In the 80s, like, and yet the chart just keeps climbing and climbing and climbing.
Right. And it didn't change until 2000. So part of my thinking with this is that, well, up until 2000 or near then, that was the first bear really, where people were able to flip back and forth more easily. Right?
Yeah.
That trading became easier for everyone. So therefore, is that what your argument is?
Well, for one, it's cheaper, right?
Yeah.
It's online, and two, if the market, if you got to call your broker to have him do the trade for you, like in the 70s, bear, he might talk you out of it, right? So people weren't calling the broker every day saying, reverse it, reverse it, reverse it.
Do you know what's also interesting, Rob? Back to your story about how you got into the business and your early foray into trading, and how you noticed that you used to go and do all the breakouts, and then it was around 2002 you said you started to notice that those breakouts didn't work anymore.
Yeah.
That coincided with that strategy rolling over.
Yeah, you're right. So that was, I guess, lucky of me to notice.
Yeah.
Blind squirrel in the nut, baby.
Yeah. And then what happened is that 2008 that it has the big, like, the bear market basically whips it around. And so in essence, it closes down, it goes back up. It's the opposite. It's just back and forth day in and day out. So was that the big drop off that we see?
Yeah. So actually, if you go to the next slide, that's just a zoom of this one.
Okay, let's go do that.
All right. So this starts in 2000. So what you see is, like, from 2000 to around 2000, late 2007, it was generally chopping around. And then 2008 bear hit, and it was like, forget it. It was reversing direction hard every day. Now you think about bear markets, and it makes sense because every reaction is an overreaction at this point. Think about how emotional the market's been lately, right? It's like today we were down almost 3%.
Yeah.
And
right. And 2 days ago we were up, or yesterday
we were flying. This is the first time we've had two in a row, and the next one's bigger. But it's been jumping back and forth. Like, you get a big move one way, and you think, I'm a genius or I'm an idiot, depending on what side of the move you're on. And then the next day, if you were a genius, you're now an idiot. And if you were an idiot, you're now a genius type thing. So what this does for me is it's something I've been looking at since 2008. In 2008 is when I really identified this chart and said, we're in the choppiest market of all time. Now, how do you play choppy versus how do you play a market that's likely to trend over and over, in the same direction? So if you think about it, what you want to do is if chop is likely, or daily mean reversion, some people call it, you pretty much don't want to be using stops, or you want to have them very loose, right? Because if it's going against you, it's the likelihood is it's going to go the other way tomorrow. And you want to take your profits really quick, because if it goes in your direction, it's probably going to go against you tomorrow. So you need quick profit taking and no stops. If you're in a trending market, it's the opposite, right? You want to go in with a tight stop and you want to let it ride till it reverses. You don't want to take.
And so, do you think that have you figured out a way to incorporate what sort of market we're in to run a strategy? Like, take this as the input on whether you should run this strategy or this strategy?
Yeah. So that's one of the things. So right now I'm running some shorter term strategies, right? So if you think of indicators, one that was real popular in the last bear market was like the RSI 2. Right? Have you guys?
I don't know. So it's basically an overbought and oversold indicator, right? Like you're fading strength and you're buying weakness, right?
Right. So it's RSI, and the typical RSI measures 14 days. So you do it for 2 days instead of 14.
Oh, okay.
Okay.
So that's what I mean. Yeah. Okay.
So it quickly becomes overbought, quickly becomes oversold.
Right.
So I remember a few years ago I did a presentation. I created some systems, right? And if you do an RSI 2 system in like this 2000 to 2008 market, what you see is, all right, as soon as it gets overbought, I want to short. As soon as it gets oversold, I want to buy, and then I'll get out as soon as it reverts. So it might be like, I'll go short at 70, I'll get out at when it returns to a 50. RSI goes between 0 and 100, and then I'll get long when it hits 30, and I'll get out again when it gets back to 50.
Now, so you're doing that on a daily chart, right? So
on a daily chart.
Yeah, so that would be the equivalent of, let's say, using still a 14 RSI on the SPY on an hourly chart, right? Have you ever tried changing the time frame and simply just looking at those overbought, oversold on a lower time frame, or do you just always stay on daily charts?
So I have looked at different time frames. Well, hang on. Let me back up a second, and then I'll address the lower time frame. So in a market like that, we got this RSI 2 reversion system. In a market like the 70s, you want to run the opposite system. So instead of going short at 70, when RSI hits 70, you go long. Instead of going long when RSI hits 30 or 20 or whatever it is, you go short, and you ride it till it reverses back up. So the complete opposite system will do better in a trendy market, or will do well in a trendy market, whereas when you're in a choppy market, you want to be playing the reversions. Now, as far as intraday, I haven't found intraday to ever show the same reliability, because I think there's more of a tendency for trend days. Like, emotions will run away during the day, right? So if things start off bad, it's not like everybody's changing their mind every 5 minutes or half hour or even hour, right? Like things start to run away. They can really run away hard. And I think that's what lends to the actual daily reversion, is the fact that, it's running against somebody and the reaction during the day becomes so extreme, right? Oh my God, I can't believe I'm gonna miss out on this, or I can't believe I'm gonna get run over by this. I'm getting out at all costs, whether that's long or short, it doesn't matter. And then cooler heads prevail overnight, and we're going the other direction the next day. Like, wait a minute.
Rob,
Overreaction now.
I'll give you my theory on that. I sat on an institutional equity desk, and we used to deal with clients that would go and sell us blocks of stock. So when someone wanted to sell a stock, we would just, work a couple of days on it and do a block. Nowadays, that block will be put into a VWAP trader, and the VWAP will go on all day. And so the reality is that the kind of whether it's a buy or a sell imbalance, because let's just think about it. You have a certain amount of VWAP buys, you have a certain amount of VWAP sells. That trend continues over the entire day, most likely. Right. So I think this is one of the problems with the market nowadays is that those trend days are huge and it just grinds. And it's tough for traders because often what you'll see is a big move up and then it just grinds higher the rest of the day. And it's really tough to trade. So in some ways, I'm kind of sympathetic to your idea that you should just trade it daily because the intraday in some ways has gotten harder. All the action happens overnight or within the first 20 minutes of the trades a lot of times.
Yeah.
Yeah. So back to the idea about this, using this as a filter for deciding whether you should be running the trend strategy or the counter trend strategy. What would be the trigger? Like right now, it's obvious that we're in a counter trend strategy because that's going down. But how long would you go before you would say that trend's changed and now we're back into you actually have to flip strategies to the other side?
I probably wouldn't flip. I'd probably just shut this off. It's kind of a stage, right? So if we're trading and now we get things just aren't working as well, it might take me a few weeks, a few months. It's really, this is just this isn't a magic line. I don't use this to turn on or off anything.
Right.
But it's one piece of information that I have, right? So I know we're in a choppy market now. And so I'm looking for those chop type systems to be able to profit.
Right. So now when you're thinking about the markets and how they've changed over the last kind of 20 years, what do you think the biggest kind of difference is between when you started, in the late 90s?
The biggest? There's so many.
Yeah, it's a different market.
No one told me that we could have negative interest rates or zero commissions or oil that was negative. Are you kidding me?
Yeah.
So it's fucked up.
Yeah.
No, but yet you're still figuring out ways to make money. And what advice would you give somebody today in this topsy-turvy environment?
So play small enough that you're not going to get killed and be agile, right? You got to be able to be nimble in your thinking, and you got to be able to be nimble in your trading. That's one thing for me that the quant research, it took me a little while, even after I started doing all the research, to figure out how to put it to use, right? But what it has done for me over the years is it's kept me sane. Like, some days things are wonderful and things are going my direction, and other days things are just awful and it's going against me. But each night I can go and, all right, which studies do I have that are triggering, and what are they telling me? And am I on the right side of this thing? And, I can do that when the market's closed, and I can kind of figure out my next move. And just being open-minded and looking at the research as it is, for me, is what, it's like seeing a psychologist every night. right? It's like,
And so, do you end up using that as your risk parameters? Like, like, let's just say, for example, you were long, and then all of a sudden you went and you got all sorts of studies that show that should be on the other side. Is that kind of your trigger to move it, or like how do you blend your trading into all these different types of strategies and these different inputs that you're getting?
yeah, so I trade a number of different strategies. So some of them will trade independent of my studies, but most of them utilize my studies in some way or another, right? So,
Right.
um,
Are you completely automated in that you're not using any judgment? Like you come up with the strategy and you determine when it'll go on and off, but then you just follow it when the machine spits it out, you go and you take your trade?
Yes, but it kind of depends on the strategy. So like I have some stock trading strategies, right? So I'll be looking to, there are long short strategies, right? Where I might trade S&P 100 stocks. And I will only take long trades if my market bias agrees with them. And my market bias is basically, what are my studies showing? And then are we overbought or oversold? I generally don't chase anymore. Most of my systems are short term. A lot of them are mean reverting. So I want the market to be oversold versus where I expected it to be a few days ago,
Right.
based on my previous studies, if I'm going to go long. And I want my studies to continue to say, yeah, there's an upside edge. And that'll allow me to take my stock triggers for the next day on the long side, and I won't be taking any short. If I get into with a short bias, I'll only be taking short trades the next day. I won't be taking anything long.
All right.
So, go ahead, Patrick.
Well, first of all,
Yep.
actually, before I do have a question, but Kev, you totally Rob's been joining us for a beer throughout this whole time, and we forgot to ask him what he was drinking.
Oh,
so
yeah.
Before I even get to my question, like Rob, you've been sipping on something. What are you drinking out there?
It's Lagunitas Sumpin Easy Ale.
All right. Is it
Lagunitas? Where's that?
Is this or Pabst?
That's not a beer; it's a diuretic.
For you, it is, buddy.
Yeah.
So I want to just ask you though, and Kev, I don't know if you were still on the same track there, but really one of the things I wanted to sort of kind of get out of you is like, do you have any market themes right now on the market that are out of consensus? Like right now, there's this big struggle with, is it a bear market? Is it, or what's going to happen? Is there a view that you have on this whole market that is a little bit out of consensus? Is there something that people don't agree with you on that you think you're going to be right about? Is there something that you kind of want our listeners to know about you in terms of some of your major themes?
Well, I think that from a trading standpoint, the major theme, one thing that I shared already is the now that we're in this choppy environment, you got to be nimble. From my standpoint, I've done a lot of studying of the Fed over the years. Each week, I show the Fed's system open market account and the growth in that, or if they're dialing it back, the shrinkage. And so when the Fed started pumping, I mean, they're pumping at like an incredible rate right now. Like it blows away anything that was past QEs. And past QEs have always been good for the market. So in general, I have avoided shorting when the Fed has been pumping strong. And I decided not to do that this time. So I have been flipping long and short. My shorts have not done well in the last few weeks, as you might imagine. But
so why did you choose to not do it this time? May I ask why?
Because from my standpoint, my Fed data goes back to 2003. And this is nothing like we have seen over that time. The Fed's beaten everything, but what we're dealing with, like the sell-off in March on its own from a high was something that was never seen before. Not even there was never a 34% decline from an all-time high in 23 days. Like
Right.
not in the 30s, not ever.
Right.
So
Well, it's interesting because if you go, and I was going to, in the talking charts segment, talk about 1929. I was going to pull up a chart on it, but really what happened there is that the first leg for several weeks, almost a month, basically bled a little bit, and it kind of trailed along the highs. So the ugly part of the sell-off that did the wipeout didn't start from the actual printed high until like a month later, and that's why when you're doing your quants, you see that it's longer, but the real ugly part actually happened just as fast. It was about a 3-week drop that was 35%, but it was already a month off of its high before that began, right? And so this was what was unique about this was we were like literally printing a high, and then the thing just completely collapsed right from the high. That was crazy. You're absolutely right? It's
right. 87 is kind of the same thing. It was a few month wiggle, and then you had the big drop, right?
Yeah, exactly. And so that's definitely unique about this one for sure.
So Rob, I'd like to actually ask you a question. You're kind of a quant. You're not I would say you mix a little bit of technical, and you're probably not like in the Jim Simons kind of PhD of mathematics guys. But I was wondering what your feelings are about that whole industry and how you think those guys end up making such great returns. Do you think that their strategies are selling kind of, are they mostly mean reversions? Are they climbing on board trends and momentum? Is it a little bit of both? What's their secret sauce? Did you have any sorts of insights or even just speculations about that?
I wish I knew. I like their secret sauce. Like, I don't know. I think they've just got so much more firepower, and that's something you gotta. If you're an individual trader, even a small money manager, you gotta know there's so many bigger fish out there, and that's another reason you gotta stay nimble. Like, you're playing a game against real sharks.
Right.
So
do you think that they like? Do you worry that your strategies are gonna to some extent are actually getting executed at Renaissance and that they're going to arb them out?
No, I don't.
Why is that?
I don't play in the. Well, I'm pretty agile. I don't manage that much money.
Oh no, I'm not worried about you getting rid of them, but them figuring them going and actually realizing these edges that you have as well, and basically doing it to a point where they actually arb out the potential edge.
I think that happens more these days in the even shorter time frames, right? So like, the Flash Boys and these guys are in and out so quickly, and then you got these massive institutions that are that can't get in and out real quick, right? So they're trying to ride trends one direction or another. I think for individual traders and for people like me that might manage some money, but I'm not a giant. It's the daily time frame actually ends up being kind of a sweet spot, right? Because I don't think the giants are playing there as much.
So would you argue that they're either really short or really long?
Yeah, that's kind of my interpretation, right? So they're either using their algorithms and technology to get in and out many times a day into many, many different things. Or if you're looking at like the more traditional money managers, they're trading the VWAP down and they're trying to build positions over periods of days. And so you've got to find a niche where the big players aren't going to overwhelm you. And for me, I think swing trading is an opportunity place.
So what excites you most about like opportunities going forward? Just in general, like, are you optimistic about this type of trading, and do you think this is going to continue to get better, or are you worried about like that this edge will be gone?
No, I think the a lot of the edges that I've played over the years are going to be strengthening this year and into next year and so forth, because of the fact that we're now in a volatile environment where there are overreactions, right? So I can play those overreactions. Like this is going to be great for me, I think. You get multi-day moves that people are starting to panic, and it's going to swing the other way, whether they're getting too euphoric or whether they're getting too depressed over things. And it's up to me to try and play those swings. And so that's got me excited now. It's a lot better than 2017, where we didn't have a 1% move for like 8 months.
Right, and it would just grind higher. Like that is a tough market for any traders. I completely agree. So in some ways, this
like no opportunity.
Yeah. In some ways, this volatility has been gut wrenching, but for professional traders, it's actually been a great opportunity set. So I'm going to ask you, and I'm going to leave with you with one philosophical question. That young guy that was staying in Boston and, working at Thomson, if you could talk to him now, what piece of life lesson would you give him? It can be anything. Take your time. You don't need to do it right away.
You always you should at least warn our guests.
I should warn the guests, but it's not as fun. It's more like I get like, oh, we're stalling now, giving Rob time.
Well, you're catching me on a good day, so I can give a positive answer here, right? So,
yeah. So what would you give him? What would you tell him?
Just keep doing your homework every night. Like that's what helped. That's what has helped me over the years. I don't make my money during the trading day, like from trading. I make my money figuring out my move each night.
Right.
And just, during the day it's just executing. Right. So
you're like a good student. That's where all the extra kind of value add is at night on the extra in the homework. So Rob, why don't you tell people where they can find you, how they can sign up, and where they can follow you on Twitter, the whole 9 yards.
All right. Well, I'm at quantifiableedges.com. That's one word smushed together with 2 E's.
It looks like
bleed in the middle. Yeah.
Yeah, it does look like bleed in the middle.
Quantify bleed goods.
Yeah. And then your Twitter's a little bit like you had to do a little
without the extra
truncuation there, right?
Bled versus bleed.
Yeah, I did. You're only allowed 15 characters on Twitter.
Yeah, so it's quantifiable, and then with a capital E.
Bled versus bleed.
And then DGS at the end.
Right. Quantifiable DGS, I guess it is.
Yeah, with a capital E. I think it is actually case sensitive on Twitter, which is drives me nuts. Yeah, or at the very least, whatever you sign up on, it stays that way forever.
Okay.
It's the oddest. Yeah, it's weird. Anyways, Rob, it's been a pleasure having you on. Thank you very much. For those who want to learn more about his work, make sure you check it out. It's a terrific product, and thank you for spending time with us today.
Yeah, thanks, Rob.
Thanks for having me. It was great fun getting to talk to you guys. I didn't finish my beer.
Oh, Chuck, we had you talking too much.
That's right. It's hard when you're chatting. Thanks again. Take care, Rob.
Thanks, Rob.
All right, bye-bye.
Lena, hop on.
Hello.
All right.
Okay, so beers.
Today?
So I went, I'm going to start because I always let you guys go first. I went and I'm stuck with the Jealous Mistress.
Ooh. That's a good beer. We had it as a sponsor before.
Yeah, it is.
So you went and bought it, more of it.
No, I found it and I put it in the fridge. 6.7. So I'm going to go. What are you guys drinking?
All right. So I've got, and this is awesome from, this is my new favorite beer. It's from Rorschach Brewing on the east end of Toronto. And it's called the Truth Serum.
Is it a sour?
No, it's a double dry hopped IPA. It's like a 6.5%, but this thing is awesome. And you know what? During this entire lockdown, they if you order $50 a beer, they do free delivery. Like, so anyone that's within a stone's throw of Toronto that can order some of this is awesome shit.
Oh.
Anyway, Lena,
How about you, Lena? What are you drinking?
I'm actually drinking something really fancy right now. It's
Oh.
called, I may butcher the pronunciation here. It's called Eau du Robinet.
Yeah, you did. Fancy drink for a fancy gal. I like it. What does it taste like? What is it?
Oh, this is so good.
It's actually
Patrick,
tap
let
water.
Lena speak.
It's just tap water.
Oh, it's tap water. Nice.
I was trying to make it fancy with French, but I guess my pronunciation is just terrible.
Oh, that's going to be a theme of
Okay.
the show today, I'm pretty sure.
Okay, so let me do our
legal shit. Go for
legal
it.
stuff. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include seeing technical rock formations everywhere, boulder bacterial blastoffs, and or granite gastric gasoline gallstones.
All right. Let's get it on with the show.
Okay, Patrick, it's time for my favorite segment, Talking Charts. What do you got in store for us today?
Listen, I was so inspired by Rob coming on and showing some of those spreadsheets, analyzing some of the past bear markets. And so I found a great charting software that goes all the way back. So I figured let's just take a tour of past bear markets and see how they played out. What do you think?
Sounds good.
All right. So I have here, obviously, the current market drop on the Dow Jones. And this is particularly interesting because a lot of people that are looking at the NASDAQ and so on see a chart that basically has rallied all the way up, right? Like we've undone so much of the damage, but the Dow continues to be a massive laggard in this move. It still has, in my mind, all of the characteristics of a bear market bounce. But I wanted to just go back and most people know what the 2008 bear market looked like. By the way, we're on a weekly chart, so we're kind of zooming out a little bit. And really what I wanted to highlight was that there were these periods like over here. Let me just use a circular thing. But there's periods like over here where we had these up to 50% plus retracements of the prior moves. And often these moves tend to take a lot longer than most people think. Like, for instance, this move lasted 56 days, this entire bounce off of that low. It took 2 months for that bear market bounce to kick in before it turned. And so a lot of people today, they feel like any one day this bear market will resume to the downside. But one common theme you'll see as we go through so many of these bear markets, these bear market rallies can sometimes last a lot longer than just like a 1 or 2 week little bounce, right?
That's right. Like that bear market rally, Patrick, was longer than the bear market we're currently in.
Fair enough, buddy. So I thought this was really interesting. This is what I was mentioning earlier to Rob during that interview. After the 2000, like that March 2000 peak in NASDAQ. So actually, let me just show the NASDAQ chart I have here. So you can see that we had the blow off top over here on the NASDAQ, the first massive leg lower on the bear market. So that decline over there was about a 40% decline in that phase on the downside of the NASDAQ, right? And almost like Fibonacci's work, you had the Fibonacci bounce basically go right to the 61.8 retracement on the NASDAQ, right?
Wow.
It's almost like it works, right? But let's not get into this the squiggle debate here. But what I do want to point out is that during that time, look at this rally on the Dow. Let me change this to a different color, like red or something. So notice that this rally, it went to higher highs than all of these little consolidations right over here, right? And so I have horrible color selection here. There we go. So it made a higher high during that bounce. So even though the NASDAQ was really, and so you can see the divergence between the different markets during these moves, it didn't change the fact it was a bear market and it lasted years. But the Dow managed to muster up in 2001 a rally that went to a higher high.
Right.
right?
The trouble about the Dow is such a narrow index. And like, for example,
Yeah,
you're saying how you're talking about how it's doing badly.
Yeah,
in this
but at
rally,
the same
and
time,
Boeing is such a big portion of it because it's price weighted.
Yes, you're right. Look, I
Although
won't deny that.
Boeing's fixed that by making their price a lot less weighted.
Yes, they did. So this was that huge sideways trade range that existed throughout 1965 through to 81, right? Like the Dow just did not make a higher high for 15 plus years. But really,
Patrick, 1 second. I hate to interrupt you, but you kind of missed a couple of bear markets in there, bud.
Well, you want to do 87?
I think we have to. You should talk about it.
Well, I mean, was there a meaningful recession? I'm looking at the bear markets that actually had deep recessions around them, right? Like, I mean, by 20% correction, yes, 87 should be classified, but there was no meaningful market, like economic recession that was associated with 87, was there?
No, not really.
Right.
You're absolutely right.
So this is why, to me, it doesn't have the same. Anyway, it happened. Yes, and because there wasn't a recession, it recovered from that bottom. And so, I mean, if that criteria existed, then that you could count that. But anyway, I wanted to look at this 1973-74 move, right? And again, you had in the middle of that this bear market rally, right? And at the time, it's very easy to some trader identify, oh, look, a little double bottom and made a higher high. The trend is working. And yet, you know, it did in the end still turn, right? And it's amazing how far and how long these things last. Like this one here lasted, it was about a 15% rally, but took 70 days. I mean, it more or less went higher for 2.5 months, right? And so, but let's actually go way farther back, right? And let's go back to some of the bear markets prior. Like, I mean, you could look at something like the 1946-48 period, right? Because after this drop over here, it never really made lower lows. It just stayed like a shit market for 2 years, right?
And so it was. Patrick, you don't remember that?
No, only you can date back to then, right?
Yeah, I'm a whopping 5 years older than Patrick, by the way, or 4.
No, you're not.
But he makes me sound like I'm, you make me sound like I'm like your elder spokesman. Just because I'm bald and got a gray beard does not mean that I'm that much older than Patrick.
All right. Well, listen, I'm going to go a little backwards here. We'll go to 1937-38 as a part of the 1929 crash, right? But let's go to 1929. And again, you see a very similar characteristic, which is there was this drop, and this initial drop that happened right up along here. That was just like a lot of technicians will call it like a head and shoulders topping formation. But the first leg of the top to bottom drop in the Dow Jones in 1929 was like this 50% wipeout. It was actually no, it was about a 40% wipeout on the first leg down. But this is the interesting part. Like, look at the this bear market rally that ensued. But more importantly, look at it actually even from a time frame perspective. I mean, this thing had a rally that was a 30% rally off the low, but it lasted 150 days.
Yeah.
Right. And so for, go 4, 5, 6 months, it just keeps holding up there. And so anyone who's trying to stay short, thinking that it's a bear market rally, if you were doing it with options, you're just getting theta burned as you're waiting for this crash to happen, and it just doesn't happen right away. But it didn't change inevitably for it to continue to bleed all the way through 1931 to 32. And so the only thing I really wanted to take away from here is that bear market rallies don't have to all end in a week or two. And so what's happening now that we're a month or 2 months into this bounce everyone's like, no, if it ain't gonna sell yet, it's the bear market's over. I call bullshit on that. Like, the thing is that there are more than enough of these bear market rallies that last long periods of time. And then you have like guys like Ray Dalio that keep referring to the 1937-38 kind of period where after this little rally along the high, you had the big crash lower, and then after this big drop in the markets in 37 into 38, it's about a 50%, 46% wipeout on the downside that happened. We had, again, a big bear market rally, and this one lasted even longer. This bear market rally over here lasted all the way, about 55% rally that lasted 224 days, right? And so this thing lasted more than a half a year on the upside, and it didn't change the fact that was a bear market, and the market kept crawling lower for years.
So, Patrick, one of the amazing things about this whole 29 period, and I think it's great how you're kind of highlighting the fact that the bear market rallies within these kind of moves are longer and bigger than people ever expect. And that is a great thing to keep in mind, especially as we have this rally that we are experiencing currently, and you're still questioning, are we in a bear market or not? When you look back at history, you can say, yes, we're definitely, this doesn't preclude us still being in a bear market because we've had these things before. But one of the things I wanted to talk to you about was when you're going through those 1929, 37, and all those crashes back then, I read this great book, and it's called The Great Depression, A Diary. And
Right.
what it was is it's a fellow it was a lawyer, and he stumbled upon his grandfather's journal that he had kept during the Great Depression. And although he was a lawyer, he was very interested in finance, and I found the whole thing fascinating, and I really would recommend people that want to get a sense of what people were thinking about back then to give it a read. The one thing that amazed me, Patrick, was how much of it sounded like stuff that we're experiencing today. Like, I swear to God, it felt to me like this guy was a hard money guy that should be on zero hedge. Like, it was just shocking to me how the worries and the complaints and all the things that people are worried about was the same. And it feels like what's old is new again. And for those who are interested, give it a read, because what you'll find is that there was times that there was these rallies, and he talked about the rally in front of the election and how the incumbent president was goosing the economy to try to win the election, and then what happened is afterward it rolled over. And then he was talking about the devaluation of other countries and how that was going to cause a problem. And then the thing that was amazing me, Patrick, is how much they were worried about the deficit and the debt, and it was all the same stuff. So yeah. I do highly recommend it, and then also to go look at the charts and to realize that we got some insane moves, and maybe we are going to have that, Patrick. Like, maybe you're right, and sorry, go ahead, bud.
No, I just wanted to highlight, though, two more bear markets that my charts captured. I wish this went back to 1907, and it really ends at 1915. It's too bad, because I would have the 1907. Like, I wish there was data going that far back that we can actually chart this. Maybe there is. I just don't know where to find it. But what is cool is that just at the tail end of World War I, there was this bear market. Very few people ever talk about it. This entire bear market that happened throughout 2016 into 18 lasted about 400 days, right? About 56 weeks, just over a year, and there was very similar. It had a drop, it had a bear market rally in the middle, and then resumed. And then what's interesting is during the Spanish flu in 1918, the market never really crashed during it. Isn't that interesting?
Yeah, I actually didn't realize that.
Yeah,
I guess it was already built in.
Yeah, it was already. Yeah, like, I mean, when you have a 50% wipeout of the market, it's already got a base from which it's thing. I don't know when the actual Spanish flu started, so like maybe it was being preemptively.
I think it was 17 and 18, I believe.
So if
I might
it was,
be making a fool of myself, but I think
but it would be
I think it was-
interesting. This is now an interesting thing we have to figure out because is this market drop reflecting everyone realizing that the Spanish flu was coming in, or was the market already dropping because of some World War One event? And then when it was happening, the market was already such a low base that it didn't really make lower lows.
So I did make a fool of myself. It's 18 and 19.
Okay.
So it was the spring of 18 to the summer of 19.
Right. So, the market never sold to a lower low during that period. Or do you know? And even at the tail end of it, it rallied. Isn't that interesting? Anyway, before anyone makes an assumption that will be the case here, remember that we had a 50% wipeout of the stock market before the event, and so you have to take that into account. But then there was the 2021 crash. And again, not too many people ever talk about this, and that as well was a pretty significant drop. I mean, it was about a 45% total decline that lasted almost 2 years, and during the middle of it was another bear market rally that pretty much lasted about 2 months, about a month and a half, and had about a 50% retracement of the drop. Anyway, the point is that when people look today, and you're telling me it's Boeing, but I would argue that Boeing or not Boeing, I also think that the S&P is being mutated by the fact that 5 of the largest components make up 20% of its market cap. And when you take Amazon to all-time new highs, it's not reflecting the true market breadth of the index. And therefore, the S&P shouldn't even be that high either. So I'll push back at you either way. The point is that we have a bounce. And is this a bear market bounce? I am saying it is. We're not going to new highs. I know Rob had made a bull case on the other thing. I am a seller on that idea. What's your take?
Well, so when you're talking about Rob, you're talking about Rob Koifman, by the
Yes.
way, from last week. You're not talking about Rob Hanna.
Yes.
I am still undecided of whether it's a bear market bounce or not. I completely agree. The fundamentals look terrible. I'm worried that we've overestimated how quickly we're going to solve this issue with the virus. I don't see how we kind of bring together the fundamentals and the price action, but I'm at the same time really scared about what the Fed's doing and what it's capable of doing. And when you buy everything with a QSIP, you eventually run out of assets. And I'm just keeping my mind open. I'm not saying you're wrong. Yeah. I'm just not as sure as you are that you're correct. That's basically where I'm coming from.
There you go. All right, you heard it from Kevin. He's not convinced. All right, we'll find. All right.
So what do you got for us for this week in trading history, Patrick?
Well, it took this long for us to get here, but it's time to do John Law and the Mississippi Bubble. Oh. And so I'm going to split this up into 2 segments because we'll talk about.
He's a handsome looking fella.
Yes, he is, just like me. But I'm breaking up into 2 segments because the Mississippi company itself is a great story that should not be mixed into all of this. So we're gonna do 2 different segments on this. But what I want to talk about is John Law initially. He's a Scottish economist, and I wanted to mention the fact he's Scottish because he was a drinker, a gambler, and a bit of a womanizer. We'll talk about that in a moment. And so you, being a half Scotsman, I thought, a fellow countryman of yours, you'd be proud, right?
Well, I am. I only got the drinking half. I left the womanizing alone.
Well, what's interesting about that, so I say womanizer because it led... He was so good at it, it led to him undertaking a challenge from this Edward Wilson guy to a duel to the death over a woman. And he won. Yes, and he won. So he later was sentenced to death by hanging.
Well, that's what I was going to say. Like, he killed a man. Isn't that like murder?
Yes. So he basically was sentenced to death by hanging. So he escaped before the hanging was to happen, and he escaped out to France, where the whole story takes place. So we have a drinker.
Honestly, really? Like that's why he's in France, because he's
he was all over the place. He obviously went he went to Netherlands for a little while. We talked about Dutch in past stories and stuff like that, but he ended up in France, and that's where the story takes place, right?
Okay.
And so he he was one that distinguished money as a means of exchange from national wealth that depended on trade. So he had a view of money that was very different than a lot of hard money people. And so the story that we're going to get into is he served as the Controller General of Finances of France under the Duke of Orleans, which is Philip d'Orléans, who was the regent of the youthful King Louis XV. And so they established the Banque Générale in France. And so we're going to get into the history of all of this. The original private bank was substantially funded by John Law and Louis XV, where 3/4 of the capital consisted of government bills and government acceptance notes, effectively making it both the first central bank of the nation and, since it was only partially backed by silver, one of the first fractional reserve banks that came into existence. And it led to the setup of the Mississippi Company, which was entirely funded by this Banque Générale, which later became the Banque Royale. And so they had different ideas, originated ideas of scarcity theory of value, the real bills doctrine. They held that money creation stimulates an economy, and paper money is preferable to metal, and shares are a superior form of money because they pay dividends. Very kind of Warren Buffett kind of style stuff. And the term millionaire was coined to describe the beneficiaries of Law's schemes. So the word millionaire actually originates from this period, right? And so so Law's idea of centralized bank, which would deal with a new form of paper money, was years ahead of its time. Despite this forward concept, Law still championed mercantilistic beliefs with the promotion of the monopolistic companies through government charters. Anyway, so going back into the history of why he was given an opportunity was the fact that Louis XIV, which preceded King Louis XV, waged all sorts of wars, and the country was completely wasted both economically and financially. It resulted in huge shortages of precious metals, that led shortage of coins in circulation, which limited production of new coins. And then when Louis XIV died, 17 months after Law's arrival in France, the Duke of Orleans, Orleans, sorry, there I am going with that, finally presented Law an opportunity to kind of display his ingenuity. And so since following the war and the Spanish succession, France economically was stagnant, the national debt was crippling. Law proposed to stimulate the industry by replacing gold with paper credit. And then increase the supply of the credit to reduce the national debt by replacing it with shares in economic ventures. And so it was on May 1st in 1716, this day in market history, that Law presented a modified version of his centralized bank plan, the Banque Générale, which approved a private bank that allowed investors to supply 1/4 of an investment in currency and the other parts in defunct government bonds. And the second key feature of the proposal centered on the premise that that this bank was able to issue its own currency backed by gold. And so it enabled the currency to be redeemed by its weight in silver from the original deposit instead of the fluctuating value of the livre, which had been devaluating rapidly. And so it was then in May 1716 that Law set up this Banque Générale Privée, which private bank, which was developed to create this paper money. It was one of only 6 of these such banks that existed. France joined basically Sweden, England, Holland, Venice, and Genoa, and the bank was nationalized at Law's request. So he created the French central bank at the time. And so this new banking platform, Law was able to pursue the monopoly companies he envisioned having France bankroll his endeavor with 100 million livres in the form of company stock, founding the Mississippi Company, or the Company of the West. Now, I'm going to save the Mississippi Company for another history session. Ultimately, the company failed. But this is where we have to segue into last week's This Week in History.
Okay.
Right? Because Lena and then a number of listeners were shitting on me for my pronunciation of New Orleans. Lena, get on here.
There was a lot. We had a lot of feedback about that.
Yeah, we did, because you triggered everyone. So, but a little bit of history, right? So going back to all of this, the Mississippi Company was a company that was put together by John Law to go and discover the Americas. And they, of course, discovered the land of the West, which they named after King Louis, Louisiana. And after the Duke of Orleans, they named it New Orleans. And that was actually after a French city of Orleans. That's the city of which Joan of Arc, back in like 1439 or whenever it was named the Maid of Orleans in that famous battle of Joan of Arc, right? When she became like a saint and all this stuff. But essentially, the regent, who was obviously running things for King Louis XV, which was just like a 5-year-old king, was the Duke of Orleans. So when they found this land of Louisiana after the king, they named the city New Orleans in French. And that is the proper pronunciation of that. But
or is it?
Oh, there you go. So now this is where obviously what's the way that they call it in South New Orleans?
New Orleans. Yeah, there's many different pronunciations.
There is one man that's the authority on this, Lena. It is Jimmy Driftwood.
That's right.
Jimmy Driftwood, and we got a clip out of his song from the New Orleans, and let's just play it. Let's play it in here.
We fired once more and they began to running on down the Mississippi to the Gulf of Mexico. Well, we'll march back home, but we'll never be content till we make old Hickory the people's president. And every time we think about the bacon and the beans, we'll think about the fun we had way down in New Orleans. We fired our guns and the British kept a-coming, but there wasn't as many as there was a while ago.
Right? Kev, did you hear that? He rhymes New Orleans with beans. Yeah. Not New Orleans. Now, Jimmy Driftwood is the authority.
Is he?
He is.
He kind of sounds like an American Stompin' Tom Connors. And for those Americans who are listening, go listen to Stompin' Tom Connors, the hockey song. It's a piece of Canadiana you'll never miss. He goes through a piece of plywood on every concert because he stomps so much.
So, anyway, okay, that was our little rant. Okay, so let's deviate back onto the story. But anyway, we'll actually talk about the Mississippi Company in a separate segment because it's a great story on its own. But in the end, the company failed. Spoiler alert: it was one of the famous bubbles of all time. And ultimately, though, it led to the speculation gave way to panic, and people flooded the markets. They rushed to convert their paper money to coins, and so they made a huge run on the bank at the time to convert all their paper notes into gold, and it created huge riots. There were like dozens of people that died during those riots, and in the end, it was a huge disaster. They were openly attacking financiers in the area. So under a disguise, John Law escapes Paris, and I think he dressed like a woman. literally in a carriage and escaped and left all of his substantial properties in France and just left and took off. And it was done. He was gone. But ultimately, this collapse, some argue, created that deep-seating resent that ultimately led later to the Great French Revolution and the rise of Napoleon and all of this. And it all originated from a lot of the problems with the monarchs created throughout these periods. And so anyway, I look forward to continuing that information, but that's where we'll leave it for today.
That's a great story, Patrick. Thanks for sharing that with us.
All right. So let's move on. Well, we were going to do a WTF clip. What happened, Kev?
I fell down. I fell down and stumbled down the stairs. Boom, boom,
all right.
boom, boom.
So there we
On
go.
my
Suddenly we're doing top 3 things to watch next week. All right. So let's review last week's. And this time we got the right top 3 of last week because Lena is on top of this now. We made a fool of ourselves. That's fine.
Don't blame Lena. It was our fault.
That's what I'm saying. No. I'm saying we made a fool of ourselves. So like Lena now, we put her in charge of this to make sure.
Do you know what's the most awkward part of that? While we were doing it, I was like, this doesn't seem right, but I was not confident.
I was saying the same thing, but we were recording. It's like, whatever, let's just review what we got.
I know. I was like, this doesn't seem right. A complete mope. Amateur move. There
we go. So, all right. So the ISM numbers were still shit, but it didn't really change anything on the market. I mean, I don't think the market is hinging now on this data because everyone knew it was going to be really bad, right? And so it's been
economic numbers are almost meaningless.
Yeah, because everyone knows they're going to be shit. It's not. Like
I guess the real question is, when do they matter again? I guess once we go back to work to get a sense of, or at least partially back to work, to get a sense of how well we're doing, that's when they'll matter again.
Yeah, it's going to be a period where everyone is going to start saying that magic word, green shoots. Oh, there's green shoots everywhere. And everyone's going to be looking for this magical recovery because everyone's going to start working. And then if the data doesn't support the green shoots, that's when it'll matter again.
Okay.
Now, I'm not predicting
I actually agree with you there. That's when it matters.
Okay. So obviously we were talking about that June oil contract. Dude, I give you kudos for this. Like you put that trade on. Like, you know what?
Well, 1 second. Why don't we tell everyone what happened?
Well, first of all, yeah. So like you were just making the call that the June contract isn't going negative and that the low is probably in. But I cheat on this other podcast on you, and there was a piece about like some of the things that could go wrong, and rightfully so. I agree with a lot of the things on there, and you're like, no, I'm just going to go long the June contract.
I know.
You did a time spread though, didn't you?
Yes, I did. I did both. I went long June, and I bought June and sold.
Now, first of all, I'm not
September.
Gucci'ing this for you, right? You're already.
No, I took it off. I'm already gone.
All right.
So what for me? Okay, I'll just explain what I think happened. I agree with a lot of the worries that were expressed in that other podcast, and I'm not saying they're wrong, but at a certain point, when it becomes so clear to everyone what the issue is, and after we had the negative price move in the May contract, it was front and center in everyone's mind. And then when you combine it with the fact that the USO and all the other ETFs were rolling out, I think what happened was all the pressure that was exerted in the roll in the final month or the final week was spread out over this period as everyone was rolling. So I look at the current makeup and I say, who the heck is still long Junes? I don't think there's anybody. I think the people that are long Junes...
Well, there's open interest. Somebody's long.
So somebody's long, but I think that they're people like users of the contract. And I think that there's a lot of sellers, shorts, by wise guy hedge fund traders that are short this because they saw what happened in the previous contract, the previous expiry.
Right.
So to me, what happened was they had the bang on correct position. And I'm not going to take that away from anyone. Those hedge funds and that trade of basically being short the front months and long the back months was a terrific trade. Yeah. But once the USO and the other ETFs started rolling, the profits that would have been experienced at the end were all of a sudden experienced now.
Right.
And at that point, I said, you know what? There's nobody left. I just think that all the week longs are gone. They're out the curve. At the front end, it's time to buy it. And so I went and bought June, July, and I sold the far months, and I flipped it. Listen, it was just a trade. Even the blind squirrel, finds a nut every now
acorn,
and
isn't
then.
it? Is it a nut or an acorn?
It doesn't matter. Like, that's basically, it's all good for a squirrel. They don't care. But thanks for the kudos. I do appreciate that. That's very kind of you.
Oh my! You went balls out, dude. That was like to be able to like go along that June contract with all of that that psychological pressure that was being exerted.
But you know me, the moment that everyone tells me that something's going to happen, I'm like,
you do the opposite. Yeah, like exactly.
Screw you guys. You're all telling me this. There's no way it's going to happen.
All right.
Anyways, now watch it. I'm gone though. So just if it goes negative from here, I'm not involved.
You're not involved. All right. So now we talked about number one being the ECB and BOJ, but the Fed also talked, and so like
I know we fell down there. How did we miss the Fed?
No, look, central banks are central banks. It was all the same shit. Anyway,
I don't think the Fed's actually matters as much as the ECB. To me, the ECB is the only one that was really
that's going to drive the dollar more than anything because I think that at this point, if the euro is going to have another leg lower, I think that everyone's looking at what's happening at the ECB for the next currency move more than it is about what the Fed is doing. I think that's much more important on the currency front than anything else.
And I don't even think it's ECB as much as it is the EU. But unfortunately, it's all tied together. And because, I don't know, they just continue to just step on their feet, and make a mess of everything. And they just shock me how badly they're doing. I actually think that the Wednesday top was, we got up Thursday morning and there was big selling. I think a lot of that was from the ECB and the poor decisions that were made there and how the market didn't like it. Yeah. I continue to think that until they smarten up and figure out that they have to run deficits that are probably twice as big, and the ECB is running a 7.5% deficit right now. U.S. is running 15%, and then they wonder why the U.S. is doing better. That's why.
Yeah.
And so until we get that, it's going to be more pain for Europe.
All right. Well, let's move on to the top 3 things to watch next week. And I wanted to circle back to the Chinese renminbi. It was a month or so ago that we were talking about the breakout. No, it was about 5-6 weeks ago. And it kind of stalled and just did a Fibonacci retracement like Fibonacci's work. The PBOC, by the way, does its Fibonacci's, right?
Of course they do.
And so, but you know what? Like it's fascinating to see what is actually playing out here. Like here's the chart on the U.S. dollar yuan. Now yuan, but what it is interesting here is after this little consolidation, big breakout. Obviously, there's all this, and Trump is getting all into like the origins of the COVID and all these different things, and things are getting a little wacky. And the question really now comes: if I put this on a weekly chart. It's like we're talking about like decade highs if this thing goes. Is it? I don't know, but you know what? Not enough people are talking about it. I love talking about someone that's. Is it? Am I wrong? Have you heard?
No, I agree. Nobody's talking about it. It's off the radar.
It's off the radar. This is why I'm interested. Like nobody.
Yeah, no, I agree. And not only that, you're right that Trump is doing some crazy shit. Like he's talking about not paying treasury bonds or not giving allowing the
reparations on China for all this shit. Like that's crazy.
Listen, it is crazy. He doesn't understand that like the Chinese will just sell their bonds, so it doesn't really work. Like I don't really understand how he doesn't know this, but it doesn't matter. He can do some other crazy shit, and the fact that it's turning so hard against them does lead you to worry about it. And I don't know yet if that's the right way to watch it in terms of for the stress, but at the very least, Patrick, if it does break out, it could be let's just say a big black flag that nobody's expecting.
So help me with this logic, because I maybe I'm not connecting the dots right. But if China was the first one recovering, they are basically saying everything is hunky dory over there. They've now been able to grab a handle on the COVID-19 and get So let's call it what Trump calls it, the Chinese virus. But just all that said, it's like you would think that it would allow their economy to be stronger than the rest of the world, which is struggling with this. I mean, should their currency be suffering a deval during a period when supposedly they're the ones that are recovering first from this? I mean, am I connecting?
Yeah, but you're assuming that the currency goes with economic fortunes, and it doesn't. That's going to be political, right? Yeah. And if you're sitting there and you're Chinese wealthy, nationals, you'll be sitting there trying to get your money out because you see what the potential issues are. So it's way more difficult to judge. And not only that, Patrick, they're an exporting nation. So if they're not exporting, then there's less people buying their currency. Yeah. So on the whole, I just don't know if looking at the supposed economic rebound is correct when you're looking at a country like China. This is more of a political game than it is an actual economic game.
Yeah. Yeah. No,
and now, having said that, Patrick, go pull up the Australian dollar, because the Australian dollar, you could argue, is going much more. Their economy is tied closest to China out of all the developed nations.
It's done. It's rolling. That's a rising wedge, and like let's do the voodoo little trend line. Like whatever way you want to draw along these bottoms. The bottom line is that maybe this is the break point for this currency. Anyway,
so I would argue, Patrick, that the Australian dollar, if you wanted to look at the actual economic real, is a better reflection of it.
I agree.
Yeah.
So it's Australia's largest trading partner. I'm with you 100% on that. All right, number 2, the jobs numbers on Friday. It's going to be shit. Do you think it matters?
I don't know anymore. I don't know what matters.
You know what? Well, we've seen the pattern is every shit number that comes out, the market actually was rallying on the shit numbers. It's funny that we saw that, but we saw like 700,000 unemployment number last month, but they are now like talking is that right? Like 21 million or some stupid number like that?
I don't know. I'm not sure, because it's all like, let's face it. Everyone's sitting at home.
This is going to break all of the charts. You cannot chart unemployment and non-farm payroll shit or employment change anymore, because it's just these ticks are just mutated. It's sort of like trying to look at the continuous oil contract when it printed -40. It's like
exactly.
It just ruined the chart. Like, you just cannot do technical analysis whatsoever on that chart anymore. You have to now like for the first time, I don't look at continuous charts anymore, because I now have to look at the Julys and all this stuff, because you can't do any real analysis on that -40 print, right?
Oh, Patrick, I don't know. You're right. My wife is making our kids write diaries because she thinks that this is going to be such a momentous thing that you want to look back and remember your thoughts at that time.
I love that idea. I haven't made my kids do that yet, but that's a great idea.
I feel like we should be doing that for the market, because I told you the story about that fellow that during the Great Depression kept a journal and turned it in. Now, 100 years later, it's a book, or 90 years later, it's a book. I almost feel like we're gonna look back at this time, and it's gonna be the same way.
We are journaling. We're running a Market Huddle podcast. We can actually turn what our podcast rantings over the next couple of years right into the journal.
Nice. So people can listen to this, and they can think about what
we can have we can have a transcription of evidence of how we get it wrong continuously.
That's right. What do you got for number 1 today, Patrick?
Number 1. Well, listen, that was a turn in the markets, and I saw a headline on your macro tourist piece, and I just wanted to prod you into kind of fessing up as to whether or not you think it's a major top or not. What's your call, Kevin?
I don't know, Patrick. I like.
What did you write? Just describe what you wrote.
That just shows you how much Patrick reads what I write.
I didn't have a chance. You just published it like an hour ago.
So what did I write? I am disappointed in myself because I felt that I should have been more ready for Wednesday potentially being the top. A lot of things happened on Wednesday. It was the day before month end, and let's face it, most mutual funds and not hedge funds, but most mutual funds and traditional clients can't trade on month end. So they end up often, marking things up the day before. It happened to be Fed Day, which often is kind of a swing point.
Well, you know what? Stop for a second there. You know what? Do you know if and we should circle back to Rob Hanna and ask him that. I mean, if there's a thing, but like what I have noticed, and I've shared with my big picture trading members all the time, which is that you fade the first couple hour move after the Fed. Like the reaction was up, and it's like you fucking sell it. Or if it was
but
down,
the thing is, it was up all day on there. But then
it popped on the Fed, like literally in the
but then it closed
hours.
almost at the high. And then the thing about it, Patrick, is that it was then a Fibonacci 61.8 perfect retracement.
Not perfect. It went up. It went above it.
Really?
But it doesn't matter. It was good enough because you know what? It's
no. You're looking at the futures. Put in the cash.
Or like the SPX.
Yeah. It doesn't matter. It's good enough. It's horseshoes. Isn't that the line? It's good enough for horseshoes. Close is good
right.
enough. Look at that.
You're right. Yeah.
Never close there. It's perfect.
Little.
It's almost like Fibonacci's
prairie
work.
dog on. Yeah, it's almost like Fibonacci's work. It's weird. It's so weird.
Anyway, so all these things, it was definitely the Fed scared me the day before or that day with their bullishness or dovishness, and I should have been more ready for the fact that everyone felt the same way and that it could be that was the top. And so I'm more open to the idea than I was a little while ago. And I hope I'm wrong because I don't want you to be right, but I'm willing to entertain the possibility that you are.
All right. I like
What do you think? You obviously think that was the top.
Look, both me and you, we went on to that other podcast that we that I cheat on you with. You were on there with me, and we both covered at the bottom. But I made it clear at the time that it was a bear market rally, and I was going to fucking get short up at the top.
Yeah, you did.
Like, to me, this is the bounce, and this is the short. That's it. I'm not changing my tune.
Yeah,
That's
I'm willing to entertain the possibility that you might be correct, which is unusual for me.
Don't goocher it for me. Why don't you just stay long?
Yeah, I just because I'm much more flat. I'm much more neutral here, and I am worried that ended up being Wednesday might have been the top for a little while. But
there you go.
Listen, Patrick, it wouldn't surprise me at all if we're grinding back higher and confounding everyone that's like sitting there saying that this is it.
Well, that's your top 3 things to watch, and so let's move on. So I put together a little parting wisdom from our good friend and regular listener Peter Lynch. No,
how do you know he's not? Like, let's face it, maybe he does.
No, probably
he enjoys a good strong ale.
Yeah. So
he's probably retired now. What's he gonna do?
He's got to listen to the Huddle, and so he said, "You get recessions." You have stock market declines. If you don't understand that's going to happen, then you're not ready and you won't do well in the markets.
Wise man.
This is why all you guys that are pitching that the Fed is going to take the markets to all-time new highs don't understand that there are recessions.
Oh, Patrick,
and then you don't understand that there are market declines, and you know what? You're not going to do well.
So I would argue, Patrick, that a lot of people are not saying we're taking it to new highs. Do you think there's people who really believe that?
Yes.
But most of those people
are people that believe that.
Most of those people
it's a
believe
V bottom.
Like,
this is it. It's done. It's a V bottom. It's just.
But would you not argue that most of those people think that the virus is a hoax?
No.
Really?
Give me a break. No.
You don't think so? Like
No.
You think there's people who think the virus
a hoax? No. The people that are buying this market believe that. So if a guy like our good buddy Jimmy Jude is bullish, you're saying he thinks it's a hoax?
No. Jimmy Jude doesn't. I doubt he's like balls to the wall long here.
Okay.
Because
all right. But I'm just saying, like, there are people out there, like you're saying, Rob Koifman or any of these other guys that they're
no.
like,
I think Rob was just saying he's deferring to the action.
I'm not trying to call either of them out. All I'm trying to say is that there are a lot of people that are already saying that was it, and that was the bear market, and the low is in. It's a V bottom. Yeah, maybe we retrace. Maybe we go back. Even the Goldman analysis was a retest of 2,400. They didn't even think the market's capable of a lower low. You know, I just think it's a bear market, and that this is the worst recession we're kind of seen in a very long time. And the market is capable of the deflationary impulse in this phase. While you probably will be right about your inflation narrative over the long term, over like a 2, 3, 4 year time frame, on the short term, asset deflation, I still believe, in spite of the Fed printing money at historical levels, is still the path of least resistance. And I think the market is fully capable of not only retesting its lows, but it's capable of even going lower. That's my call.
Okay, I enjoy your conviction. I don't have I don't have as much conviction either way. I'm still up in the air. And in fact, if I had to pick, I'd pick neither. I think people are going to both be wrong.
Listen,
no new lows, no new highs. We just sit here within this range and piss everyone
but that's
off.
what happened. But that's what happened in 1937. Like for 2 years, it didn't really make a lower low. It didn't really make a higher high. We showed that chart, right? Like,
yeah. So that would, Patrick, that would actually be my guess on what happens. Well, just to make everyone mad, because nobody can be right, and that's how I like it.
Well, look, I mean, if you shorted 2,900 and you clipped a 500-point drop to 2,400, and then it didn't make a lower low, could you say that the bears were wrong?
No, you're absolutely right. There's a lot of moves, and I have a good buddy that talked about this the other day. He said even if we get a situation where we neither get a new high nor a new low, there's still a lot of room in there for traders and movement. And that's the one thing that people need to understand is that we could have a 15, 20% decline again.
Easily.
And then that's not really a new low. Anyways, let's wrap this bad boy up.
Yeah, Lena, you're going to have to get on here. Everyone likes to hear you
do the wrap up. Plus she's much better at it than us.
Because I didn't even know that there was that little bell feature on YouTube.
I didn't either. I figured it out last time when she told us.
Like Lena knows these things, and it's
she's a millennial.
Yes,
it's year 2020, gentlemen.
Yeah, I know, but
get with the program, amateur.
Well, you know what, Lena? When Patrick first approached me to doing a show, and he said he wanted to do it on YouTube, which is completely to Patrick's credit, I was like, YouTube? That's like what my kids watch. I was like, I wanted nothing to do with YouTube. He had to convince me, and then I watched him, and I said, you know what? I kind of get it. Like, I get it.
If we can do it, I can do it, sort of thing.
Yeah, fair enough. But so I'm useless at YouTube. Like I am. The only thing I did do is I finally paid up. Stupid Google got my money because I hate seeing the commercials, and I like to have it playing in the background. So I actually paid the money for the Google Premium or whatever. YouTube
Google Premium? You mean YouTube Premium?
YouTube Premium.
What is it, like $15?
It's all in the same, right?
Yeah, it's like I feel bad because I don't like supporting Google. I have issues with Google, but at least I actually prefer paying the money as opposed to them spying on me. Like I'd rather they just take my money and then than spying on me.
Okay. All right.
So in some ways I kind of like it, and then the other thing is there's a lot of good stuff on there. Like there's a lot of good concerts, and I put on live shows, and like I actually enjoy it. So I'm basically like a Gen X that has begrudgingly accepted YouTube.
You mean you're not a boomer?
No, I'm not a boomer. What? Someone said that the other day. I was like, oh, fuck, I'm like the biggest Gen Xer ever.
What?
Yeah. Oh. New Order, Violent Femmes, Depeche Mode. Like I'm like,
oh, I love the Violent Femmes.
Oh, I know they're so good. Like I actually shocked that people don't like that. None of the younger kids.
If you're listening to this episode and you don't know who the Violent Femmes are, That's your homework for this weekend.
Yeah, go listen to the Added Up album or whatever it is, the one with the little girl looking in the window.
All right, listen. Let's get to the. We'll talk about this in the after. Let's just
wrap up the show.
Okay, like first of all, we got to thank Rob Hanna for a great interview. That was pretty good.
He was terrific. I'm really a big fan of Quantifiable Edges. Make sure you go check it out.
Right, and Lena, what are we forgetting? People have to follow us somehow, right?
Yes. Follow us on Twitter at The Market Huddle.
Oh, Lena, you're doing such a good job with it.
Oh, yeah.
There's so many.
It's just called reading.
No, but Patrick, no, not that. I'm talking about the Twitter because you took it over. And for those who don't follow it, go follow it. Lena's got like, what is Cuppy's? She had a great poll about who Cuppy looks like the most with his beard. And I loved it.
Please go vote. We got to tell Cuppy for his next appearance, so please go vote.
Yeah.
What he looks like.
Go vote. Anyways, there's some great stuff. So make sure you follow the Market
and
Huddle.
also share the love. If you enjoy this, share it with a friend. If all of our listeners just share it with one friend, the huddle will spread viral.
It'll be like an STD.
Yeah. All right. Anyway,
spread the love, not the virus.
We shouldn't talk about viruses. Anyway, so
that's a poor choice of word. That's why I went to STD right away. And like, then Patrick,
Well, spread like the corona.
No. Too soon.
Too soon. No shit. All right. By the way, this is also available on iTunes, Android Play, Podbean, Spotify. So it's not just YouTube. So make sure if you want to just listen to it on the go, there's all sorts of ways to listen as a podcast. You can do that. Make sure you give the thumbs up if you enjoyed the show. If you don't do the thumbs down. No, just kidding. But and that's it. Lena, did I forget anything? Our Twitter handle.
Don't forget to subscribe.
Yeah, subscribe to the channel. You can follow Kevin. Kevin where?
At Kevin Muir. And you can check out my podcast. You can check out my blog or my letter at themacrotourist.substack.com. Yeah, I know. They should really give me the ability to just have the macrotourist.com.
Yeah, oh my God.
But like Substack is great apart from that one issue.
But can't you just forward the
I try to
URL?
forward it, but the trouble is if you've gone to the previous one and then it's in your cache, it's a problem. It's a shit show. So that's why I just tell people the Substack.
All right. And so you can follow me at Patrick Ceresna on Twitter, as well as you can check me out at bigpicturetrading.com and get a free trial. And is there anything, Lena, or should we just go wrap it here?
I think we can wrap it
All
here.
right.
Okay, great show, guys. Take care.
All right. So I'm Patrick Ceresna, and
I'm Kevin Muir.
Have a great weekend, everyone. All
okay,
right.
so I looked it up. The Violent Femmes, the album that you want, it's the debut album, and it's called Violent Femmes.
Ooh, hard to remember.
Blister in the Sun, Kiss Off,
Yes.
Please Do Not Go, Add It Up. So, Patrick, I got to tell you.
That's
yeah. The first time I heard Add It Up, I was like 15 years old or 14 years old or something like that. And it was the most exciting song because they used the word fuck in it. I had never heard this. Like, I was like, whoa, oh my God, they used the word fuck.
It was, what a great album. And I had it in cassette, I had it later in CD, and now I have it downloaded on my Spotify. Great album.
Lena, do you know who the Violent Femmes are?
I've heard of them, but I don't really know.
Oh my God. So listen.
I'm more of a Depeche Mode
So
girl.
true. Like I play a little guitar, and every time I go look at like a tab for the Violent Femmes, which is basically like sheet music kind of deal, they always say, well, it is the Violent Femmes, so you can basically just hit any note you want, and it'll kind of work. I think they're a little bit all over the place. Like there's no doubt about it. It's a little crazy, but it's just a terrific band.
Oh, yeah.
I'm a huge fan.
I'll have to check it out.
I'm actually shocked that Patrick, that you're a big fan.
Well, I was a kid at one point, right? Like,
really? I actually kind of thought you would.
If back then, like I wasn't working 12, 14-hour days and piling.
You actually did some stuff?
Like, yeah. Back then I was just a kid, and like, what do? You like drink beers and you listen to music.
So do you think that, speaking of being a kid, do you think that Rob Hanna, he talked to us about how he liked Alex P. Keaton. Do you think he was wearing a suit and bringing a briefcase into high school? That's what Alex P. Keaton did. I forgot to ask him.
You should have.
I should have actually asked him.
And he
Alex
told us off the air those jokes. So we got to have him back to just.
Yeah, he did have a
fucking-
good joke. We'll have him back at some point.
We won't spoil it.
We won't
now.
spoil it now, but
It was very funny.
Alex P. Keaton, he was a great guy. A great character.
But we got to talk about this week's picture, Kevin.
Oh my god.
You like that, eh?
Yeah, we got to talk about
Here,
it.
let me
Yeah.
find it. I got.
So for those who don't know, they're listening to this, I got a picture and it says something about, Patrick, are you getting it?
Yeah, I'm getting it right here.
And the picture says something about Kevin's technical analysis. Oh, there. Kevin's idea of technical analysis, the rare rock formation. And there's Kid Rock, Chris Rock, and The Rock all together.
And the Rock Johnson. You got it.
Rock Johnson. Oh, sorry, whatever his last name is.
What's his first
But
name? I only
who's
know him as
guy
The Rock.
holding-
Dwayne.
His name's Dwayne.
Yeah.
But who's the guy holding the BlackBerry?
Yeah.
What year is this picture?
Oh, it's
from?
old.
BlackBerry. It's got to be 10, 15 years old.
And how high does Kid Rock look?
Kid Rock.
He looks stoned out of his fucking mind.
And then look at The Rock, Dwayne The Rock Johnson looking at him going, hey, buddy, is that English?
Yeah.
Like, he's like... And then Chris Rock is sitting there going, how the hell am I in between these two fools?
Yeah.
That's
It's a good picture. I like it.
Yeah. It's a great picture. Yeah.
Oh.
I bet some people don't even know what a BlackBerry is anymore.
Yeah, they don't.
Really?
Oh, for sure. The I got a new show for you, Lena.
Well, what
It's
is
a movie. Let me just get the name of it. I should be more ready for this. Patrick, you tell us while you're doing this whether you actually watched anything. I'm trying to figure it out. I'm
laughing
just
'cause he
trying.
hasn't.
The phone.
But
you
I
know
started
what?
watching Bosch
I'm in
again.
a phase where I'm discovering all sorts of movies my kids never seen that are like, what the fuck you mean you didn't see it? Like, for instance, like my two younger kids never seen Forrest Gump.
Oh, that's a great movie.
Yeah, and I'm like, you've never seen Forrest Gump? It's like, we're watching Forrest Gump, all right? So like, I'm at a stage.
Did they enjoy it?
Oh yeah, they liked it, and
Oh, really?
they did. But the thing is that I'm at a stage where it's like I'm actually going back, and it's like those movies like my kids never experienced. It's like, yeah, I want to take them. So I haven't been looking at too many new things, but that's not a surprise for you guys.
Well, that's good, though. Patrick, it's good that you're doing stuff with your kids. I like it. Okay, so here we go, Lena. Now,
Yeah.
this is, I got to preface this by saying that one of my favorite movies of all time is like Manchester by the Sea. Okay, so I am a
Okay.
little bit of a sap, to say the least.
Clearly.
Yeah, clearly. Like
You
know
just
what?
let
Like,
every one of our listeners know this, but
Yeah, listen, I think Manchester by the Sea is a beautiful movie and it's outstanding.
Beautiful,
and
made me cry.
I honestly do. I think it's one of the best movies of all time. So this one is called Blow the Man Down. And no, why are you laughing? Have you seen it?
No.
Anyways, it's really
Sorry,
well
I
done.
just- yeah.
It's very subtle. It's really, really well done. And it's artsy. I'm not giving you like Armageddon. Like this is obviously like for those who don't appreciate an artsy movie, don't go watch it. But if you are the type that might like that, it has 99 tomatoes. And you know how I feel about the tomatoes. Can't go wrong with the tomatoes. The tomatoes are the best thing ever.
Is this gonna make me cry?
No, I don't think it will. Nope. It's good. Anyways, go watch
okay.
it, Lena. Report back. Tell me what you think. Blow the Man Down.
I'll give you a movie report.
Give me a 7. Yeah. So, you know what? Listeners will be interested. Now you're on the hook.
That's right.
all
T-
right.
You have to
Well, it's
tell
funny
us.
you're not
report
putting
back.
me on the hook. And it's like,
Well, because you're not going to watch
I'll
it. He's not going to watch it. And not only that, I just don't think you're going to like it. You're going to be like, there's 99 tomatoes. You're going to be the one tomato. Going to be like, fuck that.
Really?
I don't know. I'm not sure. I just don't think it's your kind of movie.
No.
I don't know what kind of movies you actually like. So, Patrick,
Yeah,
what's
yeah.
your favorite movie of all time? Oh, give me
I
top
like.
3.
Well, okay. I like Fight Club.
Okay, that's a good movie. Yeah.
That's a good
Yeah,
one.
that's a good one. I like Inception.
Okay.
Okay.
Should I joke with you guys and say Titanic, but I'm not going to. But
I thought you were going to say Hot Dog, the movie.
you know what? I did actually enjoy Pulp Fiction a lot. It's probably the one movie I've seen the most time. I probably watched Pulp Fiction like fucking. You know what though? Actually, that's not true.
I could definitely
see your.
I can see your genre, Patrick. It's kind of coming through, bud.
Yeah, but you know
don't go watch the Below the Band.
As a kid, the one movie I watched the most of all was Commando. As a kid, with Arnold Schwarzenegger.
Commando.
As a kid, man, like I think I watched it like 20 times.
So
and
okay,
the other one as a kid that I watched a shitload of was on repeat was Spaceballs. I think I've seen Spaceball like 20 times, and I've watched it again with my kids.
Wow.
Like what?
Do you know what's funny, Patrick? I was watching this great documentary on the weekend that my wife made me watch, and I'm not sure what she was trying to tell me, but it's called Asshole, and it's basically
I actually
about
know exactly what your wife was trying to tell you.
Yeah, so it's actually a great documentary. Like it's really terrific, and it's basically this one fellow that this philosophy. Too many beers. There it is. It's called Assholes, a Theory. Okay, that's what it's called. And it's this fellow, this philosophy major that or professor that came up with this theory about what an asshole is and what defines the behavior of an asshole. And the funny part about it is that Patrick, the scene from Spaceballs, if you remember when they talked about the assholes, they used that clip numerous times.
Oh, wow.
Yeah. So anyways, listen, this is my second recommendation. I actually really enjoyed this. It's called Assholes, a Theory. It's a documentary. Go watch it. It's pretty fascinating stuff.
There you go.
I actually, you know what I thought about when I read it, when I watched it, I thought about sending it to Ben Hunt. You know Epsilon Theory?
Yeah.
Because he's very much like into people that put themselves above society because they think they're better than everyone else, and his whole shtick is kind of calling those people out. And I'm a huge Ben Hunt fan because of all those things that he does, and I felt like this movie would resonate with him.
Now I really have to go on.
Yeah, so there you go, Lena. You got 2 things to report back on to us.
Will do.
Okay.
I see Patrick's really quiet already. It's time to wrap up.
I'm actually
that's
texting.
I'm going to go because I got McDonald's waiting for me. Friday nights.
Oh, right. I'm so jealous.
I know. Friday nights we go out and we order out, and the family's vote was McDonald's, so I got a double Big Mac and fries upstairs.
All right. Well, don't let it cold.
jealous.
Like cold McDonald's sucks. You gotta eat it
No,
well.
all McDonald's is good. I like it. I'm a little bit of a McDonald's.
All McDonald's is better than no McDonald's.
Oh my
Exactly.
God, I'm not a fan. I'm a seller on your idea there.
Well,
I can't eat that shit.
really?
You had a bucket of chicken last week.
Yeah.
I
Was that
had a bucket of chicken the other night. There's this amazing fucking bar that sells like a bucket of chicken, Kentucky style, but they just like most wicked chicken. Like just it puts KFC's franchise to shame. Just like the best.
What's it called?
They make.
Give him a shout out.
Mugshots
Is it Popeyes?
Tavern, Keel and Bloor area, and they make the best fried chicken with mac and cheese. Great deal. Like you get a 10-piece bucket, like $48. That's Canadian dollars, by the way.
Okay, I'm going to leave you with one last thing, and then we're going to go. You know the KFC logo? When you see it, he's got like a little bow tie.
Yeah.
Okay. Look at it again closely because it's actually
like a stick
a
person
stick
with a
man.
big head.
And once you
Really?
see the stick man, you can't unsee
Can't
it.
unsee it.
So it's basically stick man with this huge head.
I'm gonna
There you
look.
go. Gotta go look. Go
All
look at
right.
the logo, and then you'll never be
check
able to
it out.
see it again. Anyways, have a
All
great
right.
weekend, everyone.
Yeah,
Thanks
have a
for
great
tuning in.
weekend, everyone. It was a
Have
good
a good
episode,
weekend.
eh? It
I
was-
liked it.
Yeah.
Okay. Yep.
Yeah.
Patrick, I wanna
are
go
we
eat
gonna-
my-
Are we gonna?
I wanna eat-
Are we heading to New Orleans?
I want to go eat my McDonald's. I'll talk to you later, buddy.
Yeah.
See you later.